A highly successful multinational corporation just finalized the acquisition of a fast-growing, mid-sized competitor. The corporate finance team did their standard due diligence. They audited the tax returns, they checked the balance sheets, they reviewed the employment contracts, and everything looked perfectly clean. The acquisition was celebrated as a massive strategic victory. But 8 months later, the joyride abruptly ended. Federal customs agents arrived at the new parent company's headquarters and handed the chief financial officer a retroactive bill for $50 million in unpaid import duties and fraud penalties. The acquired company had been secretly faking their customs classifications for the last 5 years. Because the acquiring company bought the business, they legally inherited every single ounce of that toxic federal debt, completely wiping out the profit margin of the acquisition and destroying shareholder value. Welcome back. Today, we are taking a masterclass deep dive into the absolute highest stakes financial trap in the corporate business world. We are exposing the nightmare of successor liability in global trade and why your standard corporate M&A due diligence is completely failing to protect your executive board from unliquidated customs debt. This is the exact blind spot where high-level corporate finance and global supply chain compliance violently collide. When a company decides to acquire a competitor or merge with another business, the financial and legal teams conduct exhaustive audits to uncover hidden liabilities. They hire top-tier accounting firms to ensure there are no secret lawsuits, unpaid corporate taxes, or pending labor disputes. But they almost always forget to audit the border. Customs and international trade compliance is a highly specialized, isolated niche. Standard corporate accountants do not know how to read a customs entry summary. They do not understand the intricacies of anti-dumping duties, tariff engineering, or export control licenses. Therefore, they assume that if the target company's general ledger looks balanced, the supply chain must be compliant. That assumption is corporate suicide. Customs debt is fundamentally different from standard corporate debt. It is unliquidated, meaning it is entirely invisible on a standard balance sheet until the government formally initiates an audit, which usually happens years after the illegal imports actually cross the border. Here is exactly how the government weaponizes corporate mergers against deep-pocketed buyers. Let's say your target company is a mid-sized electronics distributor. For the last 5 years, their logistics manager has been aggressively suppressing the value of their imports by hiding royalty payments from customs or illegally using a duty-free classification code to keep their profit margins artificially high. They looked incredibly profitable on paper, which is exactly why your company bought them. The moment your company issues a press release announcing the multi-million-dollar acquisition, government algorithms flag the transaction. Customs authorities read the financial news. They know that the small, non-compliant company they have been watching just got bought by a massive, wealthy parent corporation. The government will immediately launch a comprehensive historical audit into the acquired company. When they uncover the 5 years of customs fraud, they do not go after the old owners who already took their payout and retired. Under the legal doctrine of successor liability, the government goes directly after the new parent company. Many corporate lawyers mistakenly believe they are safe because they structured the deal as an asset purchase rather than a stock purchase. They assume that by only buying the physical assets and the customer list, they leave the legal liabilities behind. Customs authorities will ruthlessly pierce that corporate veil. If you buy the assets, keep the same warehouse, retain the same employees, and continue selling the same products to the same customers, Customs will rule that there is a continuity of enterprise. You are the exact same business operating under a new name, and you are 100% strictly liable for every single customs crime committed by the previous owners. So, how does a chief financial officer and a corporate acquisition team legally shield the parent company from inheriting a toxic supply chain? You must integrate a relentless trade compliance firewall directly into your M&A strategy. Pillar number 1. Mandate pre-acquisition customs due diligence. You cannot rely on standard accountants to audit an international supply chain. Before the acquisition is finalized, you must deploy highly specialized trade compliance experts to forensically audit the target company's historical import and export data. They must sample past customs entries, verify harmonized tariff classifications, and review all active free trade agreement certificates. If you do not audit the border, You do not know what you are buying. Pillar number 2. Structure aggressive escrow holdbacks. If your trade experts uncover a potential customs liability during the audit, you do not necessarily have to kill the deal. Instead, your legal team must restructure the financial payout. You must force the seller to leave millions of dollars in a secure escrow account for up to 5 years post-acquisition. If customs comes knocking with a massive retroactive penalty, you pay the government out of the seller's escrow money, legally protecting your own corporate working capital. Pillar number 3. The post-acquisition prior disclosure. If the acquisition has already closed, and you suddenly discover that the company you bought was violating trade laws, you must act immediately. You cannot hide the paperwork and hope customs never finds out. Your compliance team must immediately file a formal prior disclosure with the government. By voluntarily reporting the previous owner's crimes before the government initiates an audit, you can legally shield your new parent company from the massive punitive fines, reducing your exposure strictly to the unpaid duties. Do not let a highly profitable corporate acquisition turn into a federal indictment. Inheriting a broken supply chain is the fastest way to destroy your company's balance sheet. Is your executive board currently finalizing a merger or acquiring a competitor? Are you absolutely certain that the target company's supply chain is not hiding millions of dollars in unliquidated customs debt? Stop gambling with your corporate working capital. Head over to customsmanager.org today and schedule a free expert call. Our specialized M&A trade compliance experts will conduct a highly confidential procedural health check on your target company's import data and expose any hidden liabilities before you sign the final contract. If you have recently acquired a business and suspect their past customs records are non-compliant, do not wait for the government to find out. Contact the Global Trade Helpline at Customs Manager immediately. Your first consultation is completely free, and we can guide your legal team through the complex prior disclosure process to protect your new investment. And finally, to ensure your executive board stays ahead of these aggressive corporate audits and regulatory shifts, click the link in the description and subscribe to the Customs Manager weekly curated briefing. We deliver the high-level trade intelligence your C-suite needs to make safe, profitable decisions. Thanks for watching. Audit the border, protect your acquisitions, and partner with Customs Manager. See you in the next video.